Let us begin with a structural inefficiency that currently occupies a vastly disproportionate amount of space in our public discourse: the perceived ideological fragmentation of the political left. For the better part of the last 12 months, we have been subjected to an endless, highly publicized audit of the Democratic Party's internal purity tests. The prevailing thesis, frequently peddled by observers who seem to mistake the brutal mechanics of governance for a collegiate debate society, is that this coalition is fundamentally incapable of tactical unification. We are told they are perpetually trapped in a state of organizational decay, fracturing under the weight of their own ideological contradictions. However, this generalized anxiety fundamentally misinterprets how political capital is aggregated and deployed. It is an emotional reaction to what is, in reality, a standard decentralized management model. If one were to analyze the internal operations of a functional political syndicate, let us utilize a federal legislative delegation from a state like New Jersey as our empirical case study, the illusion of a civil war quickly dissipates. It is replaced by the far more mundane reality of administrative compromise. Within such a delegation, you find a portfolio of personnel that spans the entire available spectrum, ranging from reliable corporate centrists to vocal progressive outliers. It is entirely expected that these individuals will periodically manufacture highly dramatic public disputes regarding secondary policy objectives. This theater is a necessary operational cost. It pacifies their respective donor bases and generates the required engagement metrics to sustain their localized brands. Yet, when we examine the actual balance sheet over a multi-year fiscal period, this ideological posturing becomes entirely irrelevant. The localized coalition remains flawlessly united in its primary structural mandate: the aggressive extraction of federal capital to subsidize local liabilities. They are not dispatched to the capital to resolve the grand philosophical struggles of our time. They are there to balance the municipal ledger. Their actual function is securing the necessary federal appropriations to offset infrastructure depreciation, manage regional flooding liabilities, and underwrite the steadily escalating costs of public education and healthcare. From a purely strategic standpoint, requiring absolute ideological conformity across this coalition would be equivalent to a corporate board demanding that every single shareholder possess identical investment horizons. It is an exceptionally poor strategy for market expansion. The only truly viable growth sector in the current political economy is the independent voter bloc, a demographic that is actively divesting from both established party monopolies. Consequently, what the media breathlessly reports as a fractured and chaotic primary season is, in economic terms, simply a routine stress test. It is a necessary friction that prevents organizational complacency, ensuring the political product remains viable for the impending market cycles. This brings us to a secondary hypothesis frequently promoted by the progressive flank: the assumption that their relentless pressure campaigns are solely responsible for shifting the financial architecture of the party's leadership. They point to the recent trend of established figures publicly severing ties with their traditional venture capital underwriters and Wall Street holding companies. We routinely observe prominent senators loudly refusing contributions from corporate political action committees and single-issue ideological funds. The left naturally interprets this as a triumph of moral persuasion. The reality of the transaction is somewhat more pragmatic. When an elected official begins their career operating within municipal districts where the median household income falls precipitously below the federal poverty line, maintaining a credible working-class brand is a core asset. Over time, as they ascend to the federal level, they inevitably discover that the capital city operates on a currency of symbols rather than material substance. Early attempts to audit the banking sector for systematically draining the capital of low-income account holders through predatory fee structures often yield minimal legislative returns, but they produce excellent symbolic dividends. Eventually, a basic cost-benefit analysis reveals that accepting corporate PAC money constitutes an unacceptable brand liability. It is not necessarily that a modest corporate contribution fundamentally alters a senator's voting record. Bribery at this level is rarely so direct or efficient. Rather, the reputational cost of the symbol simply outweighs the financial injection. Therefore, refusing corporate capital is not an act of sudden ethical enlightenment. It is a strategic repositioning designed to mitigate exposure to a thoroughly discredited campaign finance system. The situation has predictably deteriorated since the sweeping deregulation of political spending, resulting in an influx of specialized issue area PACs. These entities function essentially as hostile creditors, constantly demanding public declarations of allegiance in exchange for short-term liquidity. The rational response for any political operator attempting to maintain a semblance of operational independence is to refuse their capital entirely. Yet, one should not mistake this localized tactical adjustment for a systemic cure. The broader institution remains structurally compromised. We are currently observing an environment where the judicial branch is routinely subsidized by billionaires offering unregulated fringe benefits, ranging from luxury recreational vehicles to undisclosed hospitality, while members of the legislative branch utilize asymmetrical information to execute highly profitable trades on the equity markets. The influx of dark corporate money is not merely an unfortunate externality, it is the core operating system of the current federal government. The strategy to forcefully eliminate this financial architecture is not born of mere idealism. It is a necessary intervention to restore a baseline level of consumer trust, without which the entire political monopoly risks a catastrophic devaluation. The average taxpayer already operates under the mathematically sound assumption that their representatives are entirely captured by corporate interests, effectively rendering the working class an afterthought in the legislative supply chain. A persistent, albeit superficial, market analysis suggests that the two major political conglomerates offer virtually indistinguishable legislative products, rendering the average voter's investment of time effectively moot. We frequently hear the complaint that the dominant factions within both parties are clustered so tightly around the ideological center that there are no salient differences to justify the effort of civic participation. However, evaluating the internal ledger of the Senate immediately exposes this as a fallacy of scale. Observe a standard procedural dispute over what are colloquially termed tax extenders, a deliberate euphemism for targeted corporate subsidies. If one were to audit the conservative portfolio during these negotiations, they would find a list of complex financial mechanisms designed explicitly to offshore domestic capital and shield specialized industries from their tax liabilities. It is fundamentally an aggressive wealth protection strategy deliberately obfuscated by impenetrable legislative jargon. Conversely, the opposition's term sheet in these exact same negotiations invariably prioritizes instruments like the Earned Income Tax Credit and the Child Tax Credit. This is not a vague philosophical disagreement, it is a stark divergence in capital allocation. One model subsidizes corporate capital hoarding, while the other attempts to inject necessary liquidity back into the working-class labor force. Despite the relentless media appetite for an existential civil war, the overwhelming majority of the Democratic coalition functions with a remarkably mundane consistency. Upwards of 90% of their daily operational bandwidth is dedicated to minimizing overhead costs for the working class, regulating basic living wages, and expanding municipal access to health care. Calling this a radical agenda is a gross misallocation of terminology. It is simply basic macroeconomic maintenance. Furthermore, the true bulk of this party apparatus does not reside with 43 senators in Washington. It is managed by thousands of local mayors, county commissioners, and municipal administrators who operate on shoestring budgets, combating policies that actively depreciate the value of their communities. Yet, the progressive critique often fixates on the margins, arguing that debating whether the top marginal tax rate should hover at 37 or 39% proves the leadership is entirely disconnected from the consumer base. This critique conveniently ignores the actual structural reforms currently being drafted, which propose the total elimination of carried interest loopholes and seek to rectify the absurd reality where multi-billion-dollar conglomerates record exactly zero in federal tax liability. Proposing a $75,000 standard deduction is not a minor adjustment to the tax code. It is a massive structural overhaul designed to effectively exempt the working class from federal income tax while simultaneously halving the child poverty rate. These are not fringe concepts. They are highly viable, radically pragmatic policies that command vast market approval across the political spectrum, from organized labor to independent contractors. This strategy is simply a modern iteration of the Roosevelt administration's approach in the 1930s. Roosevelt did not build a durable political monopoly by obsessing over internal ideological purity or alienating demographics. He executed a masterful expansion of the political center by offering a superior economic product to rural agricultural workers and urban laborers alike, thereby securing market dominance for his coalition that lasted well into the late 20th century. Achieving a comparable unified dominance in the impending election cycles requires a similar consolidation of tangible, deliverable assets, rather than indulging in theoretical intramural debates. This naturally brings us to a highly volatile variable: market acquisition of the anti-capitalist youth demographic. There is currently a relentless performative demand for established political operators to legitimize digital commentators who traffic in inflammatory and often aggressively baseless rhetoric. When a high-profile streamer levels entirely fabricated accusations of foreign lobbying influence directed at Jewish media figures, a maneuver that reeks of historical institutional prejudice, the strategic question is whether capturing their specific audience justifies the inherent brand damage. A competent executive must theoretically interface with hostile markets to refine their own product. Disagreement is an effective stress test for policy. We must acknowledge that the historical failure of the political establishment was its complete refusal to venture outside heavily subsidized, generational echo chambers. While opposition operators were actively securing market share on emerging digital asset classes, engaging young demographics on gaming platforms and mixed martial arts podcasts, the traditional establishment essentially ignored the demographic entirely. Rectifying this communications deficit is a mathematical necessity. We are transitioning away from a generation of aging leadership, and converting localized youth cynicism into active voter turnout requires engaging them on the platforms they actually utilize, providing a modernized framework for the American economy. However, this mandate for broad market engagement does not obligate an operator to participate in every available transaction. Engaging with a fundamentally unserious commentator who relies on the rhetorical equivalent of a penny stock pump-and-dump scheme is a remarkably poor investment of finite political capital. Good management dictates a simple rule for mental and organizational health. You do not have to attend every argument to which you are invited. It is highly advisable to audit your media engagements and allocate your energy and your capital solely toward investments that yield a tangible, productive return for the broader social structure. If you found this audit of our political infrastructure sufficiently grounded in reality, consider allocating a fraction of your attention to our continued analysis by subscribing to this channel. There is always another ledger to balance, and we will be here to review the accounting.